Hey guys, Novice Unicorn here. I'm a novice. I don't know anything about stock trading or equities, and this is just my opinion. And just wanted to throw this out there because this is a video on moving averages, and how not to be an idiot and listen to bunches of people on forums and trading communities posting stupid stuff, delusional rather than mathematical. And they are usually the people that say they're blocking bears. Okay. They're usually the people that say, I'm going to block this bear because I think the stock I like is going to go down. They don't realize math. Okay. I'm going to show you a couple, just a couple quick. You can actually pull any chart you want, and find this if you look. And so that's why it's one of my core principles or core analytical pieces when looking at something. And on my calculations here, the way I have my chart set up, the teal is the shortest moving average, which is exponential. It's the 8 EMA, 20 DMA or daily moving average, and then this blue line is the 50, and the pink is, or fuchsia if you like, is the 200. Some people use 10 weekly, which is 70. I mean, there's different ones. This is just the ones I use. This is kind of like kind of standard, which algos like to use. So it's kind of why I use it. But the argument today was this drop off in arena. What I don't even I've never even pronounced AUPH. You only need foreign letters. You don't need a word. So, but the consensus here from people was to buy this on the dip. It's so good. The offering price, this little green area here, this green bar that I have drawn in here, is the low bid and high bid on the after hours offering price that they did with institutions. So there was a lot of institutions that bought in this zone back here. And there's actually some institutions, if you go to fintel.io, you can see that bought up in that range. They also bought a lot of puts, which, you know, they were protecting their long position, but when somebody buys a lot of puts on top of a long, that kind of means that they feel this thing, that they're not going to catch this when it drops because they're going to make money when it drops. So, if you go to fintel.io, you can see that. But the debate of whether this is going to go up is moot, because unless there is a massive player that comes in with a lot of money and shoves this thing, it's not going up. And it's based on averaging. First of all, you're very far away from your 200, which the 200 acts kind of like a magnet. Anytime that something's far away from that, it wants to pull back to it. Now this is moving up, so the pullback is going to be reduced. If the 200 was moving down, the pullback would be even greater. Okay, and you can look on, even maybe on this chart. This chart's not long enough to see it. There's not enough 200 days in there. But if you look back, like the 200 kind of acts like a magnet. When something's running above it, that's generally bullish. Whenever you see something cross 3 moving averages, that is very bad. Okay, a short-term moving average crossing, okay, you're below that. You know what? I'll zoom in a little bit so it looks a little, so you can see a little better. Now I'm no genius here, okay, but average is average price. If you're not above average, that means there's more sellers than there are buyers. Okay, that's a fundamental. If you're below average, There are more sellers than there are buyers. It doesn't matter what the price is. It means that if somebody wants to buy, they want to buy less than the average. If somebody wants to sell, they have to sell lower than the average. That's it. That's fundamentals right there. That's what an average freaking is. But as you can see, you go from shortest length of time to longest length of time is the strongest. So an 8 is weaker than a 20, and a 20 is weaker than a 50, and a 50 is weaker than a 200. But 200 is like its own rule. 200 like kind of breaks the rules. So you have to learn that. But the point being is that when you have an 8 EMA and this stock is traded for how many days below the 8 EMA? It's trading below average for the last 8 periods. A week and a half ish. And then you have it. Here's your 20. It's now started trading below the 20 for the last 8 or so periods. Here's your 50. It's now started trading below that. Well, that wasn't really a good square. A rectangle. For longer. Anytime you see the 8, the 20 cross the 50, that's not good. This little pop off that, I don't even know what that was. It's because of this. It's because of earnings. And people are like, oh, they're going to release really good news. That's hype. Anticipation made that move, not math. Anticipation. If earnings was out here, this thing would have just tanked right here. This upside would have been gone. And so anytime you see a lesser moving average cross a larger moving average, that's bearish. That's fundamental. Anytime you see multiple cross, that's even worse. You had a multiple cross here. Try to hold it here. A lesser cross here. And you know what? Any time you see moving averages moving together, that is even worse or even better. Anyone saying the stock is going up does not understand a chart. If you see here, your lesser moving average is above your lower moving average, and you're above your lower moving average, and above your lower moving average, and the stock price shoots up. If we switch to EGRX, and these are both pharmaceutical companies, semi-spec pharmaceuticals, so they're not too far off of each other. Actually, this one actually makes money versus AUPH, so it's actually stronger than AUPH. Anytime you see a lesser break a stronger, and then a lesser break a stronger, and you have this downward push, you have downward trends. And then they correct here. The correction is what you look for. The correction across a lesser over a longer moving average, and the correction of a lesser over a longer moving average. You're late. You'd have been smarter to buy it back here, and you'd have made that gain. But that's risky because it could fail. It could fail. This 20 EMA could have moved away from it. You can't bet on that. But my point is, anytime you see a lesser cross, I mean, this is a great cross. The lesser's crossing 2 stronger moving averages. I mean, that's really good. And this is just only one. I don't do all my trades based on this. This is just one aspect. But you have to look at moving averages. And the concept is the distance between moving averages. When you have this is the reason I use 8, 20, and 50. But anytime you see a disparity increase too wide between 2 moving averages, they have to consolidate. But this pulled back because of the draw back to the average. And you can say, well, was earnings, was this, whatever. It's math. If you want to do the calculations back 8 days, versus 20 days and do the math, it has to pull back in. The average has to pull back in. And so it's actually MACD can be calculated the same way. But my point being is that when you see crosses happening, and this was a bad trade for me because I had several buys on the way down here, looking for it because I was hoping it would cross a little sooner. But you have a lesser, and a stronger. I mean, this thing is tanking hard, and you have a 200 here. If those are, I mean, you don't know. This is like I don't even know. That's why I sold out on the 200 DMA right here, because it could reverse. It could come in. You can see a cross, but you're going to see a consolidation period before that happens. So if I'm going to get back in, I'll wait for consolidation period. Otherwise, the slide on this thing could be huge, and that is, especially considering the MACD here, that is the slide is what you want to watch out for. And what we're going to look at ACAD, a very good stock. But I want to show you this little period right here, where it capitulated, and I actually made buys. If you followed me, I made buys on every one of these dips and made money on all of them. But when you see the lesser moving average cross two stronger moving averages, and the gap is wide, the gap means it could come in. It tried to come in there. Eventually came in here. But anytime you see this, where you see a lesser, a stronger, and a stronger, all moving, let's just call that the bear claw. There's a bear. There's a bear claw. He's a happy bear. I'm happy. I'm actually drawing a bear. He's a big bear. Rah, he's got claws. Rah, rah. And he's got legs. Anytime you see a bear claw like that, it's over. It is over. That's it. That's all you need to know. I don't know how to explain it any better than that. If we go back to AUPH, you have what looks to be the beginning of a bear claw. And your 200 DMA is way, way down here. I mean, way down there. So anybody thinking that this is like, oh, it's going to reverse tomorrow, the only way it reverses tomorrow is if somebody heavy, I mean really heavy, comes in and supports this. That's it. Somebody really heavy has to come in and support this. Otherwise, it'll capitulate on the bottom of that offering price. It's my opinion is going to drop down to 530, and there was a gap up here, so you have a 430. I mean, people are saying, well, it's never going to make that. It's never going to make that. All I gotta say is lesser, stronger. That's not good. You never want to see that. And I will tell you, and here's a way I calculate it on particularly this stock. If in institutions, and you can cut this out because it's not about averages, this is more about institutional purchases and leveraging. If they purchased, what they purchased at. I know they purchased in this range. You can go to Fintel. I pull it up. I can see you can see their buys. You can see what every institution purchased at back here. And it was all in this range, a little bit above it, somewhere a little bit above it. They were late. But if, let's say, I was the smart institution and I decided to buy it at 625, I bought it back here at 625. This stock, let's look at the high. The stock popped to 30% off of my buy. Do you think they held that? There's no lockout period on that. I bought it at 625 as it's $8. You think I'm holding that? No. I'm going to sell out enough to leverage me down. which means if I bought, let's just break it out. Let's say I bought 100 shares. All right, and I move up 30% off that. That means I have $30 in gain. I sell off the $30 in gain, which means that from my buy price, I have a 30% leverage. Gee, look at that. That 30% leverage is right at the gap. What's the gap bottom or gap top? So, these institutions that purchased here without a lockout period could have easily sold through this period out to retail, dumber institutions, whatever, gaining back their initial capital, which is key. That is a key fundamental for them. They want to gain back their initial capital as fast as possible, and which means that they can lower their stops. If I bought and I made 20%, I can put my stop out here on the last bit. Do you think I'm going to buy to prop this up? No, my stop's down here. If I made even more, let's say I made, whoopsie, sorry, that's a whoopsie. Let's say I made 20%. If I'm coming off 20%, let's say I bought in the middle of here. If I came off 20%, right around 514, I'm saying 539. But if I made off of that and I can put my stop right here, why am I going to catch this? I've already made, anytime this thing, if I think this thing is going to go up, if this drops all the way to here, I'm at break even. Okay? I'm not going to buy to prop this up. If I come down to break even and I load super heavy right here, that means that I make a lot more money. If I buy up here and it continues to drop, then I lose money. So the key is leverage. I already made my money back here on these moves over, the news that I bought and all this stuff. I have room to let this deleverage and then leverage it back up. And considering there's little price activity to support, then you have to do your calculations off of where they bought at versus where they could have sold at, and calculate out how much money they would have pulled out, deleveraging, and then lower their stops or lower their initial next buy-ins to that price movement. And that sounds crazy, but that's what a real player would do. A real player would not say, I'm buying the snot out of this right here. I'm buying it so hard right here because I want this thing to go up. No, just let this thing drop. I'm already in. I'm break even right here. I'm break even at 20% down. Load it up again. So, I had a couple other ones. SGRA. SPHS. I mean, you can see here. And anytime. Lesser crosses, you got a bear claw. That's a bear claw. I love the ice cream. I don't like it on a chart unless you're shorty. So, good luck, guys. My opinion is you have a 3-day weekend coming up, holiday weekend coming up. This is a spec pharmaceutical with a long timeline before being profitable, and you got a bear claw forming. Unless somebody really heavy comes in on this thing, downsides the game. And even worse, you have your MACD about to cross 0 point below the indicator line, game over. Don't buy this until don't buy this until it starts showing a reversal. Good luck. In my opinion, I'm a novice.